We're recording, go for it.
All right. Hello, guys. I'm Dee Lipovscak. I'm a real estate agent with York Castle Real Estate here in our beautiful Colorado, Denver metro area. I have with me Bill Azell from Synergy One Lending. He's one of the top mortgage lenders in our Denver metro market. And today we'll be doing a webinar on how to sell and buy in this crazy real estate market here in Denver Metro. So anyway, Bill, do you want to say a few words before we begin?
Yeah, I'm going to hand it over to Dee here in a minute, but I've been doing this an awful long time. I helped 240 families last year, 43% was purchase. And the proof's in the pudding. I recently closed on an investment property. My daughter's under contract on one. So I think Denver is much safer, in my opinion, than a stock market to buy. And I think a move up is going to be a great opportunity as we come out of COVID, in my opinion. I'm reading and they're expecting the market to really start opening up as we get into May. So fingers crossed, there should be a lot more to look at as well.
That's right. Hopefully more inventory in the market. So to help us understand the strategies and also what's going on in the Denver real estate market, I'm just going to share some statistics to help you understand what's going on. So let's get going to my PowerPoint, my slides. All right. Okay. So we're going to be discussing strategies for successful selling and then buying in our today's market. So to help us understand what's going on in this market, real estate market, one of the indicators we have and statistics is months of inventory. So with months of inventory, what that means is how many months would it take for the existing homes of inventory to sell in our market if no other new homes came on the market. So if we had the existing homes that are for sale right now and no other homes would come on the market, this would be how many months would it take for the existing homes to sell if no other new homes would come on the market. Why this statistic is very important, as you know, there's 12 months in a year. So if we take a half, which is 6 months, anything below 6 months indicates a seller's market, and the lower the number, the stronger the seller's market. That means sellers have an advantage because there's less sellers than buyers. And if the number is greater than 6 to 12, the larger the number, it's more of a buyer's market. So the buyers have an advantage because there's more buyers than sellers. So let's look at the situation, what we have in Denver Metro right now. So months of inventory for detached homes continues at 30-year lows. Inventory is low across the board. Smaller homes continue to see more appreciation than larger counterparts, larger homes. Even the larger properties are continuing to appreciate at about 40-year average of 6%. So what we can see at this graph, the first column is number of active homes or not active listings by square footage, increasing square footage. Second column is number of sold listings or homes. Then we have months of inventory, what I just explained, and the price change means the appreciation in the last year, and the months of inventory we had this time last year, so a year ago. So in brief, you can see that on average, we have 20 days on market. The smaller homes are obviously selling quicker, from 12 days, and the larger homes up to 44. We have on average 12 days on market, and that's Days on market means how long it takes for a home to sell once it's put on the market. And it makes obvious logical sense that smaller homes are selling quicker than larger homes. Also, with the months on inventory, we can see across the board, months of inventory is low. On average is 0.3, which is very low. It's a very strong seller's market. And for larger homes, the largest homes is 0.6, which is still a very low number. Price change, appreciation, or increase in prices, the home values from last year. It's approximately 10.7% from last year, and compared to the last year months of inventory, we had 1.1 months, and now it's decreased to 0.3 months. So obviously it was low last year, and it's even lower this year. So let's go on our next statistic. I already kind of mentioned it. Days on market. We have some data from 2008 to today. So single family home marketing times were stable for almost 4 years, from 2006 to 2009. And there was a slight increase in marketing time when the tax credit expired in 2010. And the days on market has declined drastically since then, and especially now in the last 12 months. As we can see in the graph, we're below it's going down. It's below 20 days, and as I also said and presented with the earlier slide. So this slide just shows us compares the number of sales, days on market, and average prices sold and price changes from April 2019 to March of 2020 last year, and April 2020 to March 2021 this year. So it's a year-to-year comparison by cities or different parts. And as we already said and talked, there's been increase in the appreciation has been increased. Days on market has decreased from last year all across the board. So homes are selling quicker, on average 9 days quicker than last year, and prices on average have increased 10%. And we had a little bit of more increased sales last year compared to year prior. But even though at this year we're seeing lower inventory, and hopefully, as you know, Bill and I just discussed, inventory will hopefully be increasing hopefully in the next few months, but we'll see. And I'll just mention a little bit briefly about mortgage rates and historical mortgage rates we have been seeing in 30 years. Bill will be talking more about it, but I just want to kind of show this graph and show that, for example, the average mortgage rate was 3.18% on April of 2021. If we take 2.65%, a $1,490 P&I, which is principal interest payment, could buy a $390,000 house with the 5% down payment. And if the interest rate increased half a point to 3.15%, that would decrease one's buying power a little bit to buy a $365 home in order to keep the same payment. And with that in mind, but still we have, even though the rates are slowly rising, they're still at 50-year lows. So you can see with the graph that the interest rates are coming down, the first one. And also that makes sense that buyers are eager to buy, because the low interest rates are obviously increasing their buying power, so they can buy more of a house with the same mortgage payment because the interest rates are so low. And at the same time, that's a benefit to the sellers, because buyers are able to pay more for a house, and usually homes are going with the right exposure, obviously, in marketing at or above the list price. So sellers are getting advantage of getting more money for the property, and the buyers are being able to keep their payment lower or even buy more house. So this is what's going on in the market. And this is this slide is a little bit shows us what the median price here is in Denver metro areas, the different cities, and what the price increases are. For example, in Nevada, the median close price was $505,000, annual price increase or appreciation 14.8. In Aurora, the average price was $391, annual price increase 9.5, and we'll look it down at Centennial, average price was $540 with a 23.6% of annual appreciation. So prices are going up most in Denver metro, and depending on the area, but you can see a really big price increase. And we'll be talking more, and Bill will be sharing some strategies with you later on. So with that in mind, with the real estate statistics, and to help you understand what's going on in the market. So what are some strategies for a successful sale? Well, number one is obviously the first step is preparation of a home, getting your home ready for sale, decluttering, depersonalizing, and maybe some staging. And this is something when you're thinking of selling, or when you're thinking to sell, getting ready to sell, we can discuss, or if you have another agent, discuss with them. But it's a unique situation that needs to be talked. What is the best situation for you? And obviously discuss the selling strategy. Do you want to sell your house and close on it first, and then buy another house? Or another option could be you can put your house on the market, get it under contract, and then make a contingent offer to buy another home. So buy with contingency. That is a possible option, maybe not highly recommending. Again, depends on your situation in this market, because as we've just discussed and seen, this is a very strong seller's market. So sellers are, getting usually a lot of offers on their property, and they will take the best offer. And sometimes those are not with the non-contingent buyer. So anyway, this is a strategy to be discussed, one-on-one, when unique, what's the best situation for you. Or if you're another option, and this is what Bill will be discussing, get another loan for the new property if you can carry two loans, and and also be able to finance two loans until you close on your home and buy another property, and then you can eliminate one loan. But those are some options. The next steps, obviously, when you put out your house in the market, is to receive offers, and obviously receive, review, and accept an offer. Because you only accept one offer, and hopefully with the right exposure and marketing, you could get multiple offers above your list or asking price. But you choose one offer, what's the best. And obviously this is what we could discuss when you get an offer in a property. So some things to consider is when reviewing offers, and keep in mind, you as a seller are reviewing these offers. When you will be on the buying side, you will be on the other side and keeping kind of the same strategy, but you will be on the opposite side. But anyway, let's just look at the seller side. So you will consider what kind of an offer you received. Is it cash or terms, and amount, price, terms, right? The loan, different kinds of loans, and this is what Bill can also kind of touch upon. Deadlines of the buyer in time to close, what kind of a lender they have, this is something that needs to be discussed, and me as an agent discusses with the buyer's agent to see what kind of a financing and commitment the buyer has. The buyer makes some items like inspection items, and the deadlines, and maybe some buyers are waiving some inspection items or limiting it to health and safety. So that's also showing how serious the buyer could be. And you might ask the buyers for a post-occupancy agreement, and which is like a rent back. So that means the buyer can offer to you as a seller to rent back your own house, to be in your own house up to 90 days. So in those 90 days could give you some more time to find your new move up home. So those are just some things to consider when, accepting offers, or when you're a buyer making offers. Also, earnest money, you might, if you want your offer to be, when submitting offers, buyers can sometimes submit more earnest money than you're asking, or even make them non-refundable after certain deadlines in the contract. Buyers can also elect to cover certain seller costs like title insurance or other costs. And also a big thing today, and you might be hearing, is about the appraisal gaps. I'll just mention briefly, and then Bill will talk about it a little bit more later on. But the appraisal gap is if, for example, you list your home for a certain price and you offer more than the asking price because you see the value in the home, and or the buyer sees the value in the home and they offer you 40, 20, 30, 100,000. We have seen even 100,000 over asking price. So that gap is, and there's guarantees if the appraisal doesn't appraise at that price, that the buyer will cover the difference. For example, if you list your property for 400, the buyer offers 450 and it appraises only for 400, but the appraisal gap is the buyer will then guarantee or offer to pay the difference of that $50,000. So you as the seller get the full amount that they offered in their offer. So those are some strategies, and the same or similar strategies are to be considered when buying or for successful purchase, because it's obviously much easier to sell than to buy, but these are the strategies to consider. Obviously the first thing is to have financing ready, talk to a lender like Bill, and then make sure that everything is, if you need financing to purchase another home, already ready to go, have extra funds available if needed. And that for the purposes, obviously, if you're for the appraisal gap coverage, one of the things, be ready to, if you like a home, like to see a home, be ready to view a home quickly and submit your best offer quickly. Right now, there's a lot of buyers looking, and we've seen times that you can't get a showing, and by the time you get a showing, the property is under contract. So it's really crucial for you to be able to see that when you want, see the property quickly. And if you're interested in purchasing the property, submit your best offer as soon as possible. Obviously, with the offer, send in lender letter and have the lender call the listing agent on the property that you're wanting to purchase. So they talk about your financial credibility and the strength of your offer, and then you're willing to really want the property and to close upon it. Be flexible with sellers' needs. For example, if they need a post-occupancy time or terms, same thing. If you need, or we talked about the seller side, this is also for you to consider when you're buying for another seller. Be open and able to make an above offer above list price. Obviously, what we talked about is, there's many buyers and prices, sometimes you have to offer a little bit more to get the property. And as we said, with the lower interest rates that we still have, that could be to your advantage because your payment will be still lower. We talked about appraisal gap coverage strategies, and Bill would talk about more. And another Plan B strategy could be if you close on a property, your own, you sold your primary, you're still looking for to buy a property and for some reason you haven't found something or whatever the reason, have an option of staying at a short-term rental or stay with a friend until a successful purchase is made. So this is just like a plan B in case you're for everybody's peace of mind if things just don't go as quickly as we planned or you intended. So anyway, these are basic strategies, and we'll be covering some, we'll be covering some more. We'll have a more question Q&A session at the end. But anyway, if you have no questions, this is my contact information. You can email me, or this is my website, and yeah, my phone number. You can call or text at 720-229-4926. But anyway, this is for my my part, and I'll hand it over to Bill now, and then we'll be discussing some more later on. So so I'm gonna turn this over to Bill. Okay.
Yeah, you might have to do it on your end. So it's on Facebook Live. So I emailed you the PowerPoint, and if it doesn't work, that's fine, Dee. I can just do it verbally.
Okay. All right. Let me.
Because I think you have control on Facebook.
Bill, you should be able to do a screen share if you want to try it.
Okay. Just do it like I would on the okay.
Yep,
I'll
just
try
on
it.
Zoom. Yep.
Yeah, just on Zoom. Yeah.
So let me see if this will work. So I need to be in my Zoom. Oh yeah, Zoom. Never mind. I am with you. Okay, let me make sure I've got the right one. Okay. Boom. I think it's working. Can you guys see it okay?
Yep, we got it.
Yeah.
All right, all right. So yeah, and what I heard, heard Dee say is I'm gonna, the key is with having an agent working with you on the prep stage and everything else. I think the key is a move up. You definitely want to have your house ready to go. So the sooner you can get Dee in there, the better, because she can tell you where to put your money. I got too many folks that wait till the last minute, and then they're scrambling because they see properties they want to be ready to go and they're not. And even if you can do a non-contingent purchase, I think that step you really want to do early, even if you're not sure you're ready to go right now. Maybe some people are still concerned with COVID or something else. If you're thinking you're going to do something in the next 4 months, I would probably get her in and have her point out what needs to happen, because that's the most common delay I'm seeing in the market right now. Honestly, is my client's house isn't ready. They wait too long to have Dee walk in and take a look at stuff. So I think that's a key piece when you're doing a move up that's outside of my world, but holds me up all the time. Because it always takes, it's like whenever I fix anything in the house, my wife says it's going to take 4 times longer than what I think. It's absolutely true when you're getting a house ready to go to market. So anyway, that's my 2 cents about getting Dee in real early, because it'll make you ready to go when things are ready to go. So right now in the current market, Dee mentioned contingent and non-contingent financing. Contingent financing is pretty much non-existent at the moment. And that's just because there's so many buyers in the market that the listing agents, for the most part, don't need to risk it on somebody else that needs to sell their house, because it can fall apart on inspection. It can fall apart on appraisal. There's a lot of things on a contingent offer that can go wrong. So the first area I always will go to is non-contingent financing. So if there's a way we can have you get into your dream home without selling your current home, and you don't have the ability to do the short-term move that Dee talked about, moving in with a family member after you sell, or going to short-term rental, extended stays or something like that. I have had folks do that. It works very well. But if you don't have the ability to do that, you don't want to do that, and you have the financial strength, we can do non-contingent financing. That seems to be what I'm doing quite often. I've got folks looking for very specific properties, like a horse property. Those things come along once every 90 days, you get a crack at one. So they don't want to have their house sold, and they have the ability to buy that. So what we do is they work with me to get it prepped. So when that property does come on, they're ready to go. And the number one thing with non-contingent financing with most folks is figuring out how to get the cash out of the current home into the new home. And so typically what I'll do is, if we have the ability to do it, I'll have the homeowner set up a line of credit on the current home so we can move the equity from the current home to the new one before they sell. And the cool thing is, if you do a home equity line of credit, you only pay interest on the amount of time you're using the credit limit. So if you do a non-contingent offer and you can sell your place before you have to buy your new place, you don't pay a dime on the home equity line other than what you paid to set it up. I've had several where it's only a week or 2 weeks difference between the sale of my buyer's home and the purchase of the new one. Maybe they had to do the purchase 2 weeks earlier than the sell. So it's a very inexpensive way to move money over. And I really like that tool. So if anybody's thinking, hey, I would need to do a non-contingent offer and you've got good income, because I have to look at the debt to income ratio, I think that's the number one move that I'm doing right now, is using a home equity line. We can also do a very low down on the new primary. Let's say you got some great equity on your current primary that normally you would have 20% down. But if you haven't sold it yet, you might have the ability to put 5% down. So on conventional loans, which is the majority of the loans I see on a move up, you only need 5% down. So if your house hasn't sold, if we can come up with 5% and then some reserves, and what reserves are, we have to treat your current house like it's a rental. So I have to have 6 months reserves. But if we can scrape up that amount for the purchase, we can sell your home later and then take the funds and pay down the mortgage on the new house to the lower balance where it would have been if you could have sold in advance, right? You're just kind of delaying it. Your house hasn't sold, so you got to wait to get the funds from that, pay it down. You could do something called a recast. And what a recast is, majority of the servicers we work with is they will take your, let's say you did 5% down, you owed 600. I'm just going to make it simple. After you sold, you were able to pay it down 150,000. On a recast, the servicer could take the remainder 450 that you paid it down to, use the current terms that you have on the loan, meaning whatever remaining term you have on a 30-year, for example. Let's say you have 29 years and 10 months left on it. They can drop that balance down and drop your payment down. So you don't have to keep it up forever. You just have the higher payment on that higher loan amount until you pay it down, and then the servicer will drop the payment down just so that the term equals what it was when you bought the house. So it's a really slick way of doing it where you don't have to keep the payment up that high forever. Same thing with mortgage insurance. So if we did a 5% down, we're going to be paying mortgage insurance until you sell your current house and you pay it down to leave at least 20% equity. Then we can get the MI removed too. So you can temporarily have a higher mortgage payment with mortgage insurance, but it's not permanent. So that's the nice thing with non-contingent financing, is you can make it work however works best for you. So it's really flexible. People with strong incomes that have some money to do the 5%, this is very common. Because I think last year, I have to go back and look at it, but I would guess about 40% of my people who moved up kept their current house as a rental, just to let you know. So it's a great place to be. And that's the second slide, right? Keeping your current home as a rental. Well, the market in Denver is insane. Dee just went through some statistics. I saw an article that came out from Denver Metro, Denver NAR, and DMAR, sorry. And they said from January to the end of March that the Denver Metro is up over 15%. So, man, if you can find stocks that are doing that consistently, good luck. So a lot of people do keep their current home as a rental, and it's on a conventional loan. It's pretty easy to qualify, because all you have to do is we have to get a lease in place with a deposit prior to closing on your new house. So typically we can use Rent-O-Meter, or some people use Zillow. You'll talk to your expert like Dee, and they can tell you with some reasonable knowledge on what you can rent your property for. And then we use 75% of that to offset your current mortgage payment and HOA. So if we have, 2,000 in rent that you're going to get on your current home, I can use 1,500 to offset your mortgage payment and your HOA, your housing expense, basically. So it's pretty slick. So a lot of times, if you've had your house for a while, you can actually buy your new one, and your current house either breaks even, which you have to have a rental history to take positive income on it. But there's a lot of times the rent will cover the payment on your previous house. So it's an awesome way to go. FHA doesn't work. FHA, you can't take rent if you're moving out of your current house and turn it into a rental. So you have to have a lot of income on that one. Another word of caution, I went ahead and put this in here because I get a lot of people to do this. Do not do an owner occupied refinance if you're thinking of purchasing soon. The banks, the big box banks and those, they're going to be really firm. They're not going to let you do another owner occ purchase for a year unless you sell that property you just did a refinance. Well, if you're trying to keep it as a rental, you don't want to be forced into waiting for a year because you just did a refinance on it or having to sell it. So I just recommend do not do any refinances within 12 months if you're thinking of buying another property. There are some exceptions to it. So let's say you have a small condo and you got maybe a 1-bedroom condo and family size expands. Yeah, we can look at exceptions to let you do an owner occupied purchase if you did a refinance in the last 12 months, but that's a common error. So I just wanted to bring it up today. I want to make sure we set you up for success. And that's part of the reason why, if you're looking in the refinances or anything else, you do a lot of planning with your lender, because I don't want to screw up a future purchase deal for you. But that's a real common move. I think this year we're going to have a lot of folks holding on to their current property too, because it's like gold. It's a great place. So if you're thinking about buying an investment property, maybe you keep your current primary, which has a spectacular rate and everything, go buy another owner occupied property. That's what I would recommend. Rather, if you just want to start investing, that's a great way to do it. Appraisal gap ideas. So Dee's absolutely right. So on the weekends, we have weekend coverage. Even during the week, when we're talking to listing agents, if we're in the running, majority of the contracts, my clients are saying, hey, I'm willing to pay a certain dollar amount over the appraised value. Because honestly, I almost hate to say this in public, but Monday I had 6 appraisals come in, 4 did not appraise at the purchase price. And one of them was just hard. It was a duplex. There were no comps. Everything that closed were back in 2020. So the appraiser they can't just move with the market. If we had some sales in 21, that duplex would have been much higher appraisal, but there wasn't. So that it didn't appraise. We missed big on that one. We had a condo, there just wasn't good comps. That's the problem too. When you got a market like this, where there's not much inventory, it causes problems too. I'm finding fresh comparables as the market's moving up to help with the appraisal. So, it's causing a lot of problems. So on this particular condo, it was a low rise. You could walk down one set of stairs and you were on Cheeseman Park. Well, we had to compare it to 2 towers across the way that were really tall. They're not comparable properties, but that's the best the appraiser could find, and it caused an appraisal shortage. So there's appraisal shortages are pretty common. Most of them are not that big. The duplex one was $100,000 miss, and I had a townhome and a condo that missed by 20. Both of the condo and townhome were the same reason. There just weren't sales in 21. So it made it really hard for the appraiser to come up to the current market. So they came in short. D can put in the contract a cap on the gap. So one of the ones that came in 20,000 light on a townhome, we had a $5,000 gap, meaning my borrower was willing to pay $5,000 to cover a shortage on the appraisals. We were under contract at, I think it was 345, maybe it was 445. I'll go with 445. The appraisal came in at 425. So they bought it at 430 because they said they were willing to cover 5,000 on the shortage on the appraisal. So we had the purchase price was dropped by that amount. So there's different ways to protect it, but you know, every single listing agent I'm talking to, if they're wanting to know about gaps. You can also use a family member to help with an appraisal gap. And this is especially on the move up. So if you got a mom or dad that's willing to gift you money for an appraisal gap till you sell, that might be a way to go. Now, technically on a gift, you're not forced to pay it back, but if mom and dad want to give you a gift of 30 to cover an appraisal gap till you sell, that's your business. Home equity lines. You know, so it's nice to have, even if you're not going to use a home equity line from your current property, or maybe you got enough money that you don't need to use an entire home equity line to purchase the new place, you might want a home equity line to cover an appraisal gap until you sell your current place if you're buying a new one. You know, because if you have an available credit limit, let's say 30,000, the appraisal came in 30,000 short. I could tell the listing agent when I'm talking to him, hey, my borrower's got a home equity line that's empty on their current house right now. So they have the ability to put the money down on the new house, but also got a home equity line to use for your appraisal gap. So hopefully that makes sense. So as long as we got funds available to cover a shortage on an appraisal, that's a very important tool. We can look at 401k funds. You know, you can get really creative. If you got a free and clear automobile, you can actually take money out on that to help put more money in the bank to cover gaps. But this is the #1 issue right now in our industry, also with the agents, is figuring out ways to cover gaps on the appraisal, because there's people out there with cash that will always pay over where the appraisal comes in. And that's just reality at the moment. Now, I think this will change as the year goes, but this is the hot thing. So this is where you want to really talk to your loan officer in detail if you're getting ready to go out and buy houses. How do we get you under contract? So right now, if we do not, I got a nice typo on there. If we do not want to, if we don't want to do just appraisal gap, there are other ways to win the deal. So one of them is you got to be able to talk to the agents on the weekend. So the big box banks, the internet lenders, these guys are not open on the weekend. I'm telling you, they will not pick up their phone probably till 1 o'clock in the afternoon on a Monday. The listing agents don't like that. So another way, if you're doing a move up or doing a regular purchase, is you want to wrap the deal up on Sunday before it hits Monday, because Monday morning you might have new contracts that come in. The big box banks come online, the internet lenders finally answer their phone calls. So the weekend coverage, I think, is key to winning a battle on a move up or another one too. Quick closes. So another thing that we have to do is we have to be ready to close in 2 weeks. So with a lot of my buyers, our company's actually focusing on this. We're going to start pre-approving fully so we can close in 2 weeks. Right now, 3 weeks is pretty standard with us because a lot of times the sellers want it done quickly. And that's another reason why non-contingent is so important, because a lot of sellers just want to get it done. And if we can get it done, a lot of the internet lenders of the big box banks, they're at 4 to 6 weeks or stuff like that. If we can get it done in half the time, we don't always have to be the top offer. So this is another way you can win deals. I also tell the agents we're going to do Tuesday updates. So the agents are very nervous about never being able to talk to the lender for the buyer, about not understanding the file. Honestly, they're just worried it wasn't properly qualified and there's problems. So, as part of the deal, we tell the listing agents, hey, I will be calling you on Tuesdays. I'm going to let you know exactly what's going on so that you can focus on your business. Take our deal and you'll be able to update your seller once a week. You know when I'm going to call, and you can focus on new business and not have to keep checking in with the lender. Because I tell you what, a lot of these bigger lenders, they don't pick up the phone. The listing agent continually is having to call trying to get an update, or they're bugging Dee going, hey, what's going on with the lender? I can't get any information. So So we make it open to them so they feel confident in taking your offer. We're also an entity called a mortgage banker. Huge benefit over a broker. So a broker pre-qualifies you and sends it off, gets it underwritten somewhere else, but they're not employees of that broker. They don't really have skin in the game. A banker funds, underwrites, and services all in-house. So our business model is based on controlling everything tightly from the pre-approval to the underwrite to final funding. So you do not want handoffs when you're talking to a listing agent on stuff. They really like mortgage bankers. Advantage a banker has too is the product line. So banks have their one product line. Mortgage bankers have multiple product lines, including jumbos. I think we're up to 10 investors now. We have non-QM product, meaning non-traditional product. We just have much wider variety. So it helps your buyers get under contract, but it also helps with the listing agents because they feel a lot more comfortable with a banker, in my opinion, than any other entity because they know we can get it done quickly. Experienced team. So in my case, I'm just going to throw it out there. I mentioned before, we did 240 transactions last year. 43% were purchase, and I'm 100% referral. So the difference between me and these companies you see on the internet is I got a lot more time to make sure we're properly qualifying the buyer. The internet companies, they have a very low pull through. So every time somebody logs in an application online, the internet lenders have to follow over and over and over again. They have to sift through a lot more buyers to get one person that they can qualify. So they can't focus on it. They're focusing on trying to get through all that massive amount of leads. Our model's different. We take direct referrals. So we have more time to put in on the client and make sure they're properly qualified. So our pull through is way higher. So if you're a move up or you're buying new, I think that is so important right now, especially as a differentiator when you're in a market like this, where there's a zillion people lining up to buy the house. A lot of times the differentiator is who the lender is and what kind of control they have in their experience. So that's, and believe me, we do let the listing agent know how many deals we've done. So here's the rate forecast. So I don't know what's going to happen. So right now rates are doing the opposite of what a lot of people were forecasting. So Barry Habib's one of the biggest in our industry. You know, the bond traders like just 2 weeks ago were scared to death about inflation. So we've been pretty much going straight up on rates since January. So if you go to the Freddie Mac weekly survey, which is what I use, it comes out once a week on Thursdays. On the first week in January, on that survey, we were at 2.65, average 0.7 discount. We got as high as 3.3 like in the last few weeks. So we were heading up. We were up well over 0.5%. The nice thing is, you can see there, the average rate in the US on 4/15 dropped to just barely above 3. So I thought the 2s were going to be gone forever. Honestly thought the low 3s were probably gone. But we are in a very good spot at the moment. They're improving. And when I'm listening to the bloggers and everything, they can't really say why, because everybody was worried about inflation with the spending, but rates are actually settling down. So I think that's a good thing for our industry, good thing for buying a house, because like Dee mentioned, you know, rates were at a 50-year low anyway, and now they're even improving again. So good news at the moment. We'll have to monitor that, but and why is rate important? So the next screen, I'll kind of tell you, you know, 1% difference in rate, which this is real stuff. I've seen rates move 1% in a year, you know, per 100,000. If we go up 1%, it's $75 per 100,000 for a 1% rate increase. So, you know, if you take a $500,000 loan amount, that's $375 a month. So when she was talking earlier about how rates impact purchasing power, this is why. And you know, move ups, it probably doesn't impact as much, because most of my move ups have a very good debt to income ratio because they seem to already be established because they're buying their second house. This really comes into play on first time home buyers. So if you're trying to sell a house that is worth less. If rates go up, it could put a pinch on the first-time home buyers who normally would be interested in your property. So I think it's a good time if you don't want to hold on to your first place to do a move up because of this. Because of the condos, the low-end houses, the majority of those are going to be first-time home buyers, and the majority of first-time home buyers, in my experience, have very high debt ratios. So if we do see these rates move like is in the screen, we're going to squeeze out a lot of first-time home buyers. So that's, I think the lower part of the market will be very sensitive if we see rates really spike. So if you got a property on the lower end, I think now is the time to do it while rates are good. You got first-time home buyers bludgeoning each other, trying to get into properties. I think it's just a great time to do it because you'll get, the demand's so heavy. But I don't know if there's any questions for either one of us, or Dee, if you have any comments or.
I just want to, say thank you for sharing all these strategies and tips and, your insights, also your experience, and we've been seeing in the market, especially now recently. I think that's really gonna, help our viewers. And, this is very beneficial because it's a little bit different from our real estate side, and then also from the lending side. Those are two different pieces. But as you said, we need everything to be working together, like holistically, one part, so we can win, and this is why we're talking today, to have a win-win strategy. Either if you need to sell and then buy, or just, as you said, move up and keep your current home if you wish to as a rental. And this is also that we can, I can discuss with you guys what are the rental rates and what are the benefits, pros and cons of being a landlord anytime, but also in this market.
So we don't have any questions at the moment. If anybody wants to type anything in, we'll give a minute here because there's a fairly significant delay for anybody on our Facebook audience. So go ahead and just type your questions into the comments if you have them.
Mhm.
And then one question I guess I would have for you guys right now is maybe we could get a quick COVID update and talk a little bit about how that might bear on this process.
Okay, what are your inputs, Bill?
Mine is that the appraisal's coming back. So we had a whole bunch of appraisal waivers, which everybody loved in 2020. It's causing problems with Fannie Mae and Freddie Mac, and the Biden administration is extremely concerned nationally with the real estate market. We're a totally different animal, but they said that they're expect that to be squelched soon. So I think the biggest change you're going to see is we're going to be back to almost all deals are going to require appraisals. And I think it's going to happen here shortly. So we had a very nice run where I would say probably 30% of deals we didn't need an appraisal. I think that's going to come to an end. So that's probably the biggest change with COVID, because Fannie Freddie really allowed the automated appraisal to kick in during COVID because they didn't want appraisers going into properties, right? But now they're having some issues. So I think we're going to see it reverse. And so that'd probably be the biggest change. COVID tightened up guidelines, specifically self-employed's tighter right now. So we have to get P&Ls and we have to back it with bank statements or CPA letters. And, you know, if you have a big drop on your income from 19 to 20, it can cause issues. So that will continue. I think self-employed will continue to have issues, more issues than the salaried and the regular folks until we can get into filing our 21 taxes. So we do have a window here. I think it's going to be tougher on self-employed, and the appraisals coming back.
Okay, great. Well, thanks, Bill. So from the real estate perspective, as you probably know, last year when the COVID hit, we had restrictions. We actually had some time when times we couldn't really show homes. And there was restrictions when we could only show homes when property, we got the property and the contract. So that was a really kind of awkward and tough time last spring. So even though later on we continued to show properties with, obviously with COVID protocols, and we're still using those today, but that is still causing a lot of sellers not to list their properties. And as I mentioned earlier, we're down 50%, 56% of inventory than from previous year, meaning half the sellers are selling than we had previously. But with vaccinations and with the confidence of consumers and population going up, and with the COVID cases going down, we're hoping, expecting that the market was stabilized in the, at least in the terms of number of homes coming or inventory in the market, because, you know, as we mentioned earlier, there's twice as many buyers as there are sellers, and causing this kind of tightness in the market, craziness in the market. But hopefully with everything calming down, with COVID, you know, cases coming down, and, you know, people getting vaccinated, and obviously causing more confidence, that the more sellers will be listing the property, so buyers will have more properties to not only look at, but also purchase. So that's from my perspective, Bill. Yeah, so do we have any more questions, or do you have any final thoughts, Bill?
No, I think we covered a lot, so it's a good class.
Okay. Well, good. Well, thank you so much for joining me and making this possible. And I look forward to speaking with you soon, and we'll be hopefully sharing this with our audience again in sometime soon. Okay. All right. Bye-bye now. Bye.